Saturday, August 17th, 2019, Maneco 64, home of alternative economics and contrarian views. Today I want to talk about one of John Exter's essays entitled Currencies Today Are I Owe You Nothings. It was written in June 1972. I spoke about this essay in a video earlier this week, but I want to go more into detail into this essay and why I think we are near the end of this I owe you nothing system, and that people are going to start losing faith and confidence in this system. And I think the falling yields, rapidly falling yields, and I'll show you a chart right now of the 10-year yield in the US and how rapidly it's been falling. You can see that last year in October, it was as high as 325, the 10-year yield, 3.25. And now it's dropped all the way to below 150 this week. It closed at 156. And we are near the all-time low of around 132, reached in the summer of 2016. So you can see there that the drop has been very fast, especially looking here from above 2%, especially since the end of July. It's been rapid, and that's not a good sign. I worked for over 20 years in the bond markets, and I know this is not normal. So I think yields are going to continue to drop. We know that we have about 15 trillion now in negative yielding bonds. And that's basically just as bad as in the 70s when we had inflation running higher than yields, and that gave people real negative interest rates. That's what we're having now as well. So it's the destruction of the system, in my opinion. And this is a symptom of it. So that's why I'll go over that. I want to go over that I owe you nothing article, which I'll put a link below in the description to this essay. You can read it yourself as well. And it will take a while. It's, let's see, it's a few, it's a couple of pages, but I think it's interesting for us to go through it so people can understand what our monetary system nowadays consists of. And coming from John Exter, if you've seen my video from earlier this week about John Exter and the Exter inverted pyramid, John Exter was actually a central banker. And a lot of you know that I don't really respect central bankers, the central bankers that we have nowadays. But if I had to choose one central banker that I thought was honest, it's John Exter. So he started out, I think, at the Federal Reserve Board in Washington, D.C. He helped found the Sri Lanka Central Bank in the 50s. Then he went to the New York Fed, and then he worked for Citibank, or First National City Bank, up until the late 60s, I think, early 70s. Then he got out of banking altogether, and he was a gold bug. So let's read this. This is really interesting. I read this years ago, and it helped me understand the system that we have. So this was published by the American Institute for Economic Research, Great Barrington, Massachusetts, June 1972. Currencies Today Are I Owe You Nothings by John Exter. So I'm just going to have a quick sip of my drink here in my Time to Retire the Old Lady of Threadneedle Street mug. The Old Lady of Threadneedle Street is the nickname for the Bank of England. So it's my end of Fed equivalent for the Bank of England. If you want to get one of these, it's in the Teespring store below. I've got other merchandise. In the back, it says, and I'll read, this was a quote from William Patterson, the founder of the Bank of England in 1694. This is what he said: the bank hath the benefit of all interest on all monies which it creates out of nothing. So there you go. So, and that's what John Exter says that currencies today are I owe you nothings. So let's start the essay. Now that the international monetary system we have so long known has broken down, well, Bretton Woods, 1971, this is 1972, and the world is groping through monetary reform for a new one, it is time to consider some fundamentals. What is money anyway? He says, first, it is a means of payment or medium of exchange. I prefer that first phrase. It is simpler. We all use money to pay our bills, to buy goods and services. We also accept money when we sell. Second, it is a standard of value. We quote values of goods and services in terms of it. The resulting ratios are prices. Third, it is a store of value. We hope to avoid loss by holding it. Money holds its value if it is scarce and remains scarce. Scarcity is the keystone of store of value money. So that's something we don't have in the current fiat money system, right? Scarcity. Today, no money in the world fully performs all three services. National currencies or fiat currencies are being used as means of payment and standard of value money, but none in this inflationary age is an assured store of value money. In fact, a foremost concern to voters and politicians everywhere is that so many currencies are so rapidly losing their value in terms of commodities and services. Commodities like gold and silver, which are being used as store of value money, are not being used as either means of payment or standard of value money. Thus, the world we have so long known, in which most currencies were redeemable at a fixed price in a store of value money like gold, is in disarray. People are confused and wondering what money they can trust. Sensing the instability of the system as a whole, they turn day by day from one means of payment, money, to another in the foreign exchange markets, and much more gradually to store of value money like gold in the London and Zurich gold markets. So at that time in 1972, London and Zurich dominated the gold market because there's no gold traded in New York or in the US. It was still banned. People were still banned from owning gold, monetary gold in the US. That, I think, it came up until December 31st, 1974. He continues, scarce commodity. If we carefully look into the meaning of this market churning, it becomes clear that store value money, if it is to endure, must be a commodity, and a scarce commodity too. Silver has long been a less satisfactory store value money than gold, principally because it has been and promises to continue to be more abundant. And I think he means that more abundant in terms of mining, because above ground stocks, gold is much more abundant. All the gold that has ever been mined in the world in history is still existent. Silver is consumed. But I think what he means is that in a mining perspective, you get a lot more silver when you find a lot more silver than gold when you mine for precious metals. Many of the currencies used as means of payment and standard of value money have not proved good store of value money, chiefly because they too have grown too abundant, since they are simply either paper, currency notes, or bookkeeping deposits promised to pay, i.e. debt obligations or IOUs. The confidence of people in them as store of value money depends heavily upon the ability of the central banks responsible for their issuance to honor those promises to pay in a commodity that is indeed store of value money. This is the issue of convertibility, which the Europeans, especially the French, are emphasizing today. So this was still 1972. I know Nixon closed the gold window in 71, but there is still a lot of debate about this. He goes on to say, until March 1968, when the two-tier gold system was established, the central banks issuing all major currencies were promising all holders, I owe you gold at $35 an ounce. Under the two-tier system, however, the I owe you gold promise was abrogated for private people, and except for the South African Reserve Bank, central banks refused to sell any gold at any price to private people. The I owe you gold at $35 an ounce promise was honored only among central banks and governments, and even among them it became gradually more tenuous. On August 15th, 1971, I owe you gold promise was abrogated even among central banks. And there you go. Nixon closed the gold window. So he continues, same relative rates. So today, all currencies in the world are saying, I do not owe anything. I do not owe anybody anything. Each one says, in effect, I owe you nothing in the way of any commodity that is a store of value money. In that situation, an attempt was made at the Smithsonian to reestablish fixed exchange rates, which meant making one central bank's I owe you nothing equal to a certain number of another central bank's I owe you nothings with a 2.25% spread on either side of parity. It is obvious that such an arrangement could last only if the exchange rates agreed at the time were equilibrium rates, and if in future all central banks agreed to control the issue of their new I owe you nothings at the same relative rates. The second condition was certainly not met, and no one can be sure of the first one. Although it was agreed to raise the price of store of value money gold to $38 an ounce, no arrangement was made for a central bank that went into deficit because it issued too many I owe you nothings to pay a surplus central bank in gold at a fixed price. Meanwhile, the gold owned by central banks remains, for the most part, buried inactive in their vaults. Gresham's law has worked. Bad money has driven good out of circulation, even among central banks. All currencies are inconvertible into gold. We are in a world of irredeemable paper money. Further conclusions follow from this analysis. Good store of value money is clearly the strongest kind of money. I owe you nothing money, which people may continue to hold as a store of value for a long time, but only with the enticement of ever higher rates of interest, may continue also for a long time to serve as a means of payment and standard of value. So that is quite important there. He says that you need higher rates to entice people into this kind of I owe you nothing money. And now we see that we are not getting any rates. So I think we're very close to a point where people are going to start losing faith and confidence in this I owe you nothing money. But as it becomes more abundant, it will serve these functions less and less satisfactorily, if too abundant, not at all. It would then also cease being held as a store of value, not worth a continental. History is full of examples of I owe you nothing currencies that have disappeared. Some currencies will, of course, become overabundant faster than others. Over time, it is scarce store of value money like gold that endures. That's from a central banker, John Exter. If enduring store of value money must be commodity, it follows that governments and central banks cannot create it. Unless they were to go, let's say, into the gold mining business. It follows also that if they persist in creating I owe you nothing money, they will slowly but surely run themselves out of the money-making business altogether and have to start over again. So it is also apparent and at the same time reassuring that it is private people in the marketplace, not governments, who decide what money is and what different kinds of money they're going to use and hold, especially the enduring store of value money, the most important of all. So there you have it. This is a central banker who's advising people or saying that the best place for... So here's a central banker who's saying that it is people in the private marketplace and not government who decide what money is. So he continues, Gresham's law. Governments will always try to shore up I owe you nothing money with laws making it legal tender, or even laws prohibiting the holding of store of value money like gold. But such laws cannot for very long add value to something that is losing value in the marketplace. Gresham's law, which is really a special form of the law of supply and demand, will override man-made laws. In fact, there would be no Gresham's law if governments did not persistently try by man-made laws to overvalue their I owe you nothings in terms of store of value money. So basically he's saying, yeah, the governments and central bankers can try to manipulate the value of their I owe you nothing currencies versus store of value money, gold and silver, but in the end of the day, they won't be able to do it forever. So there you go. Thus, laws prohibiting people from holding store of value money like gold cannot succeed, for gold as a commodity can be held in countless forms and readily converted from one form to another. People will hold jewelry or old coins or what have you. And people whose governments permit them to hold gold will do so in any form. It should also be apparent that monetary theorists cannot arbitrarily decide what money is. Theories that are based on an arbitrary definition of the stock of money, particularly I owe you nothing money, will slowly lose their relevance. Such theories try to overvalue I owe you nothing money, just as governments do, and in the marketplace, Gresham's law will override man-made theories, just as it overrides man-made laws. So he's having a go at the Keynesians, the PhD economists. This is back in 1972. So I continue. So it also follows that governments cannot reduce the importance of store of value money, like gold, in the monetary system, much less demonetize it. A monetary authority monetizes anything by buying it and taking it into its balance sheet as an asset and paying for it by creating or issuing monetary liabilities. Now, I owe you nothings, which are accepted by the seller. It demonetizes anything by selling it from its assets and extinguishing an equivalent amount of its liabilities tendered to it by the buyer. So now he says, obviously inflationary. To demonetize gold, the central banks of the world would have to sell all of their holdings in the open market. If they were to try, the exercise would be very deflationary, for they would be extinguishing their monetary liabilities with every sale. To avoid the risk of deflation in today's monetary world, they would simultaneously have to monetize I owe you nothings like government securities by creating new I owe you nothings of their own more rapidly than they extinguished the old by demonetizing gold. Such an exercise would be inflationary, and central bank IOU nothings would steadily lose value in the marketplace. Under Gresham's law, the bad IOU nothing money would drive the good gold store of value money out of circulation. But if the central banks persisted and there would be precious few restraints to stop them, their IOU nothings would slowly lose value under runaway conditions, all value in the marketplace. Thus, over time, the marketplace would frustrate central banks if they tried altogether to demonetize gold. It would demonetize their IOU nothings money instead. So they're not likely to try it. So yeah, they need the gold. They need the price of gold to go higher, or else they're going to fall into a deflationary trap, which they're already falling right now. It is not even likely that one central bank would try. Others would welcome the opportunity to monetize the gold that it sold, and at the same time to demonetize some of their IOU nothings. In recent years, there has been an attempt to substitute so-called paper gold or special drawing rights in the IMF for real gold. One high IMF official is even reported to have called gold metallic SDRs. If used seriously, such an appellation flies in the face of marketplace assessment of store value money. The SDR has no obliger, no promise to pay any store value money at a fixed price, and no fixed maturity date, other than a complicated reconstitution provision. It cannot be sold at will, only by central banks in deficit, and only to central banks strong enough to be designated by the IMF to receive them. So it is who owes you nothing and when. And it does not even pay a market rate of interest, only 1.5%. If central banks ever monetize them in significant amounts, they will have moved from days when they were issuing their IOUs principally to buy enduring store value money like gold, to these days when they issue their IOU nothings principally to buy government IOU nothings, to days when they would issue their IOU nothings to buy who owes you nothings. Crazy. So you can see how SDRs are not the solution. Commodity money is the solution, right? So this is how he ends. I know this is dragged on for a long time, but it is the weekend. I usually do longer videos. So here it is. In the days to come, international monetary reformers will have to consider whether these new kinds of money will produce a stable monetary world. In the world's marketplaces, will they hold their value against goods and services in general? More particularly, will those issued by different central banks hold their value against one another? Most particularly, will any of them hold their value against store of value money like gold? Well, I don't think so, Mr. Exter. I know you lived on a lot longer from 1972. I think you died in 2006. And of course, you knew that wouldn't hold, right? And that's why gold is now above 1,500, has been as high as almost 2,000 in 2011. And back then it was trading at $35 or $38. So there you go. I owe you nothing money. That's what we've got now. And that's what people need to wake up and realize, that the only way to keep the store value of your savings is to have a commodity or a store of value money, like John Exter says, and that's gold and silver. You might want to try cryptocurrencies. That's what John Exter said, that money is created in the private market. So yeah, maybe Bitcoin and other cryptos are going to be part of the monetary system. Yeah, I'm not counting them out. But I'm personally focusing more on precious metals, even though I do have cryptocurrencies. So if you enjoyed this video, make sure you hit the like button Make sure you share it far and wide, and make sure you hit that little notification bell above if you want to be notified of all my new videos. And you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great weekend. Take care. Bye.